Good day, everyone. Thank you so much for joining us today. So I'll be opening the section by saying the concept of money has continuously evolving, driven by technological advancements, changing economic landscape, and shifting societal needs. As we move further into the 21st century, the future of money promises to be shaped by disruptive innovation, digital transformation, and a growing emphasis on decentralization and transparency. Hi, everyone. My name is Amarachi, Amaechi, and I'm the co-founder and chief operating officer at Bitpowr. Please, let's give a warm welcome to our panelists. Yeah, so we'll be starting with the introduction. So, Kaj, if you don't mind, you can introduce yourself to the audience.
My name is Burchardi, Managing Director for BCG Platinum. More than 20 years in the company and focusing on blockchain digital assets and global lead for this topic.
Blake?
My name is Blake O'Donnell. I'm a partner at Punter Southall, which is a law firm here in London. I've been practicing for about 14 years and have taken a keen interest in crypto over the last, say, 5 years. I've recently published a legal textbook called Legal Aspects of Cryptocurrency in the UK, which is a practitioner's guide to what the law actually is regarding crypto in this jurisdiction, because there seems to be an awful lot of confusion about it. And I'm delighted to be here today to talk about this topic.
Good afternoon, everyone. Simit, Naik, Director of Strategy at nChain. At nChain, I lead the CBDC program. I also have a background in payments, joining nChain from Visa. So I have a keen interest in payments, currency, financial services, and I'm also a big fan of meme coins.
Thank you. I'm Vincent Mele, Director and co-founder of Otranto Limited, a specialty consulting and advisory firm focused on strategy and advisory services, primarily to central banks, but also commercial banks and product companies, in order to shape their products to best suit the needs of central banks and commercial banks. I previously was part of a global team at a large global IT consultancy, and worked on site and with approximately 15 central banks on CBDCs starting in 2018. Previously, I was an attorney in the US, also licensed here in England and Wales, so I try and bring the technology, information security, and regulatory aspects together in order to help central banks achieve sort of their monetary policy goals in the CBDC space.
Thank you so much for the introduction. So without wasting much of our time, today we're going to be talking about the rise of digital currencies and how it is shaping the future of money today. The rise of digital currencies and asset tokenization is revolutionizing how we think about money. From stablecoin to real-world assets, CBDC, money as we see today is changing. So my first question to the panel today is, can you briefly tell us some of the latest trends in digital currencies that you're seeing today and how it's impacting the society? So Kai, start with you.
Yeah, so based on our research, about 90% of the central banks currently are looking into CBDCs. The majority is in retail CBDC, some wholesale CBDC, but the large chunk is still in investigation, partially piloting. Hardly anyone is in production yet. And I think there are some good reasons for that, because you have to really carefully design such a new currency that's not just a digital cash, but something which is meaningful and has business purpose. And on the other side, you have then the stable coins, which are already for longer time in production and is massively used and have also very clear value cases for the companies or also retail investors and retail consumers. And last but not least, you have the tokenized deposits in between, which could be issued by banks, but also there it's a question, what exact business case is behind that one? And for the for the CBDC part, as well as for the tokenized deposit, I think we still have to do some work with the companies in order to redefine the area where they really make sense with a design which is protective enough for the users.
Yeah, thank you so much. Hi, Blake.
Yeah, and I would say there's two kind of trends from the regulatory perspective. Essentially, much more heightened regulation around stable coins. Central banks are very concerned about them disrupting the global financial system. And we're seeing much more progress about central banks moving forward in terms of actually implementing the framework to bring about CBDCs, but it's still a while off.
No, thank you.
Yeah, and I think it's also important to understand the drivers behind why you want to digitize currency. And depending on your drivers and the needs, you're going to choose a different solution and a different approach. CBDCs in a retail sense may make sense for a lot of countries who are looking to deploy a digital form of central bank money in as digital version of notes and coins. But in other countries, the desire and the driver isn't as strong. But there may be a need to create a stablecoin type payment solution that does create more efficiency and allow you to lower the barrier of entry for new payment systems and schemes that exist on top. And so it's important to know that CBDCs, stablecoins, cryptocurrencies, any other form of currency can coexist. I think that's an important aspect to remember. And it all comes down to what it is you're trying to achieve and for whom and where the value exists. And then you decide on the appropriate deployment.
Yeah. I would just add, I think, from the central bank perspective, I think central banks were sort of woken up by the cryptocurrency space, and which then sort of led to companies like Mele issuing and almost issuing something like Libra, and really understanding, and central banks sort of waking up, seeing these multinational corporations can issue something globally that really challenges the individual sovereignty and the individual powers that central banks have within their jurisdictions. Suddenly there was a settlement medium that could challenge the role of central banks. And ultimately Mele and the Libra Foundation wanted to act as a central bank. Whether or not they said it or not, they would be acting as a central bank, collecting and holding reserves of national currencies and creating a composite token. And central banks woke up and they realized not necessarily the threat from Bitcoin and other cryptocurrencies in the world, but it was the multinational corporations challenging them almost directly. And central banks then realized we have a role, the role they have used, and the role that they continue to need to serve, which is money as a public good. They are the bedrock for modern economies. Whether or not you disagree or agree with central banks existing or national currencies, you can't deny the fact that they are the bedrock for any economy in the world. So central banks have realized that their roles, I think, have diminished over the years. I think 2008 was a wake-up call to them, and that they need to have a more active role, need to connect more with citizens and individuals, and provide money as a public good. And you see that in not just the CBDC space, but also sort of some of the RTGS renewal projects. You see that with FedNow in the US, of sort of providing the services from the perspective of the central bank at cost or below cost in direct competition with private actors. And the analogy would be private actors in the stablecoin space and private actors issuing tokenized deposits. But that's not saying one is better than the other. They'll coexist. But central banks, I think, are beginning to flex their muscle again and connect directly with citizens just like you.
Yeah, thank you so much for that insight. So talking about stablecoins, how will stablecoin fit into the future of money, and what are the regulatory considerations we should look at? Blake, can you help us out with that?
Well, essentially, the stablecoin, as you were saying, is a wake-up call to central banks that unless they develop a better form of the current currency, that stablecoins might beat them to it. And they are very concerned about the idea of private entities being able to essentially create currency outside of the central bank system, which could destabilize global currencies. Also, at the moment, I read a paper by the Brookings Institution, which indicated about $10 billion worth of tether is being used to purchase weaponry and machinery by Russia. You know, it is a way of getting around sanctions, and sanctions are obviously an important tool in the global order.
Thank you. Vincent, do you want to add some points?
Yeah, I think the concept of stablecoins, I think, is a really interesting one, because it's not new, really. Because e-money and the concept of e-money has existed in the regulatory standpoint for many years. And you look to sort of what's happening in Europe with MiCA in terms of the concept of e-money token. You know, the risks and how they address those risks of an issuer issuing money and then, you know, holders of the claim, you know, needing to redeem it with that issuer, you know, exists in e-money regulation. And MiCA has done a fairly decent job, in my opinion, of breaking up the roles and responsibilities associated with a payment network and saying, okay, well, what the technology provides is an issuer to just issue, and the entities that are doing the transfers to just focus on the transfer regulations and just focus on the anti-money laundering and the counter-terrorist financing regulations, where the issuer doesn't need to concern about that. But the backing, the concept of having a token that's backed by reserves or money held at a commercial bank already exists in existing regulations. So stablecoins, which I think is an ambiguous term already because it doesn't mean a single concept. I think, you know, is a better model is an e-money token, which I think, like I said, will be the answer to stablecoins in Europe very soon. And I'm curious what you think, Blake, about, especially in the UK, sort of what is the role of an e-money token compared to, say, an less regulated or unregulated stablecoin? If
well,
expand that out.
I mean, the bank, there is stablecoin regulation coming in fairly soon, and the Bank of England has suggested that they want the reserves to be held with the central bank, one-to-one.
Yeah.
They won't get any interest. They won't be able to deliver any interest to the holders of it. It's going to be very regulated. They're basically making it so that only traditional financial institutions would be interested in doing it.
Yeah.
And I think we're going to see that as well. That's going to happen in Europe too. I think SocGen have just introduced their own euro stablecoin. So, you know, there's going to be less scope for private companies who are kind of, you know, more like buccaneers.
Yeah.
To get into the space. I mean, I think they want to, you know, you can do it, but you are going to have to jump through the hoops, and you're going to have to do it properly.
Yeah.
I think that's exactly the interesting piece where potentially Europe is putting a lot of regulation how to structure the stablecoin compared to, for example, in the US, right? Where a circle can make quite a bit of money just because they have a certain fraction of the reserve with interest-bearing methods, right? And that is the reason why you can actually create a quite nice ecosystem, which is massively used also across the world. But so we have to balance, also from a market perspective, what is the restricted form of control versus what makes sense potentially in the market.
Yeah, and I should say that that's just in relation to payment stable coins. That's what everyone's really worried about. They're not so concerned about people using stable coins on exchanges, trading in and out of crypto. That's a separate category. Agreed. The payment stable coins is really a substitute for money. So, yeah.
Yeah, and I think it's also important to note that when we talk about regulation and risk, you know, it changes depending on how and what type of stablecoin you're talking about. Because as Vince says, stablecoins is an ambiguous term. It covers multiple different types. You know, you've got fiat-backed, which is what we're talking about with Circle. You've got algorithmic stablecoins. You've got asset-backed stablecoins, and you have crypto-backed stablecoins. And the risk profile for each one of those changes. And none of them are without risk. I mean, even fiat-backed stablecoins like USDC still had a big depegging issue last year when their bank, Silicon Valley Bank, went under, and they had a massive challenge of providing liquidity and the capital controls. And so even if you did it within regulation and you still did it as fiat-backed stablecoins, there's still an element of risk that exists. The risk gets bigger as you go down, and when you get to an algorithmic stablecoin, then the risk there is huge, and the controls and the protection are less. And we saw that with Luna, and when they had Terra Luna backed by the Luna token. And so when you talk about stablecoins and currency in general, risk is always going to exist. It's just the level of risk you want to take and what regulation exists for consumer protection.
If I can add one thing to that, Simit, I think you brought up a very interesting thing with Circle and USDC, because one of the things that I think was lost in the news somewhere was the fact that that depegging was because of the risk of in the traditional financial system of Silicon Valley Bank going under for a variety of other reasons, but the perception that Circle and USDC provided deposit protection to consumers, to holders of the token. And they actually, I think, had to change their sales material because it seemed like, or gave the impression of, holders of the token were subject to deposit protection in the US, and that was not the case. What it really was that Circle was holding money in traditional bank accounts, but the billions of dollars they had in USDC were well over the limits of the FDIC guarantees. So when Silicon Valley Bank went under, the bailout of Silicon Valley Bank, the biggest recipient of being propped up was Circle and USDC and the holders of USDC tokens. And that sort of goes under the radar in these so-called stablecoins. Even the fully regulated, supervised ones in which everything is transparent still have risks that are traditional financial system risks. And that is often why, and I'll come back to the central bank aspect, the public money aspect of it, is that is exactly what the regulators are supposed to root out. Everything will work well and work well as a payment medium when everything is going fine, but it's the moments of financial shock that the central banks and everybody turns back to the government to then say, well, I didn't know this risk, I didn't want to accept this risk, I need to be bailed out. And in all fairness, retail customers are really the least to blame here and really should be protected. That's why deposit protection exists. So you end up with these very complex products to solve, I think, a relatively simple problem, tokenized money, that then have inherent risks, as Simit just pointed out, that aren't always obvious and only come to light when financial stress happens. And that's where things like central bank digital currencies, that's where central banks say, we need to provide very strict regulation and only allow traditional financial institutions to provide stablecoins or tokenized deposits because we know how to regulate them, they know how to be responsible with their balance sheets. Silicon Valley Bank, an exception, but still there. And also, we need to provide public money in the form of CBDCs. And I think it's an important trade-off, and it's not, like I said, it's not that one's better than the other. They will continue to exist, but the risks don't go away. And I think, and there is no free lunch. So, the stable coins that offer yield, that yield is not free.
Sure.
Plus, you have a different business purpose for them, right?
Right.
A lot of CBDCs are just in the same jurisdictions, whereas the stable coins are completely global, and therefore the cross-border remittances as primary use case for them as well.
All right, thank you so much for that insight. So we have seen the rise of cross-border solutions, especially in emerging markets, and how stablecoins are disrupting and enabling fast and cheap payment alternative. What are your thoughts on that, Kai?
Well, what we saw already, or what we see already, is in stablecoins, you have as a consumer, and you can go on any common exchange also, you can send the stablecoin in a very easy way around the world with no cost. But what we also see sometimes in very different jurisdictions where we don't have maybe the benefit of a very stable currency, clear regulation and good behaving banks, that sometimes stablecoins are much more beneficial for the consumers and the merchants than necessarily the local money. When you have high interest rates, high inflation, especially there's a really big money flow going between South America and the US. So the merchant at the retail store is asking for the stablecoin from their own clients, because with that one, they can much easier pay the goods from, for example, the US, via stablecoin, no cost in transmissions, and then they get the goods to South America and sell it. So there is really a complete circle outside of the SWIFT corresponding banking relationship, for example, which is perfectly working fine. And it's lower risk for the merchant compared to, I make it up, in Argentina, where you have a super high inflation rate. So it's win-win for both.
Thank you. Anyone have anything to add?
So I think, we've seen a lot of examples of stablecoins making cross-border payments a lot more efficient. And it's interesting because the concept of stablecoins came from providing stability against a volatile asset class. And so for a long time, there was no utility in stablecoins. You either kept them on an exchange or you didn't do anything with them. And they were a hedge against the bull and bear markets of cryptocurrency. But now people are starting to see what power there is in being able to move money cross-border, cross jurisdictions, very quickly and very fast. And it uses the concepts of the underlying technology, right? They're all influenced by Bitcoin. And then you're starting to see removing intermediaries makes the process cheaper, faster, and more efficient. And that's really why you use a stablecoin to do that. You can do cross-border payments today. It's just going to take time and it's going to cost money. And so now we're starting to see how stablecoins are providing a solution to a problem that's existed for a long time. I don't think it's the answer in itself, but it will help us to start evolving our thinking and approach to how we see these digital forms of money and currency being able to address some of these challenges. We mentioned Swift. Everything goes through Swift. Swift is a messaging protocol, but it adds cost and complexity. Stablecoins today, we both got USDC wallets. I can send it to him now in seconds, right? We bypass all of that. But then you've got to balance the risk and the regulation and some of the other compliance requirements that exist. So it's good that we're starting to see this kind of proof of concepts and pilots coming out because it's starting to bring utility, but there's still a bit more work to be done. And I think that's where CBDCs will also come in at the wholesale level to help deliver a more efficient cross-border payments.
Yeah, I think there's some fantastic work done by the BIS that we were involved in. First of all, Project Enbridge, it's based out of Hong Kong, but 4 central banks are building a common platform to issue CBDC and be able to transact that CBDC amongst each other. And they have over 100 other observer central banks that want to participate or are observing and may participate. And that fits, BIS has sort of categorized sort of 2 major models. And the first one is a common platform in which everyone agrees to be part of a common platform and may issue into it. And you can do some creative things like have a basket currency and do some creative things on that. But ultimately, there's governance issues with that. And that's more, you can think of that more in the decentralized world, right? It's closer to the decentralized world in which the central bank participating on that may delegate its validation features to the quorum of other central banks, which has its own challenges associated with it. That's the first model, and Project Enbridge, I think, is a fantastic example of that. It's going live, I think, this year, at least in an MVP stage, but real transactions have happened. That's PBOC, People's Bank of China, Hong Kong, UAE, and the Bank of Thailand are the first 4 participants on that, and it's a very exciting aspect there. The second model is what they call interlinking. So it's under the assumption that these domestic networks will continue to be silos and may use a variety of different technologies, but there's significant technological advantages in coming up with common standards to use atomic transactions or use oracles or use things in order to use the best technology available given a bilateral relationship to execute transactions between them. India has done a lot in that space. And that's, the BIS has done a lot of work on that. Project Icebreaker and a new one that was just announced a few weeks ago, Project Agora, is one that sort of being addressed mostly by Western countries and larger central banks, including the Fed. But fundamentally, it's to get around the SWIFT problem. It's to avoid the necessity of an entity like SWIFT being needed to be in the middle of all of these transactions. Which inevitably then exposes everyone to EU jurisdiction and soft pressure from the US. And I think there's some prime examples of that where the US was putting pressure on SWIFT, which is a Belgian company, Belgian cooperative, not a company, cooperative, to delist certain number of Iranian banks. And the EU explicitly said, we don't agree with what the US is doing. We don't want those banks to be delisted. And SWIFT is a Belgian cooperative, so subject to EU law, not the US. And SWIFT came up with a very creative solution for this. They resisted, and I don't blame SWIFT for this. They're just in the position of being the single entity that has this much control. SWIFT resisted, but ultimately came with a creative solution of saying, we are delisting and removing the identity of these Iranian banks for operational reasons, not because of legal reasons, and they got around it. But what you see is that the single entity has all of this control and is caught in this geopolitical crossfire. And countries, especially in Central Asia and elsewhere, don't want anyone to have that control. It's not an anti-American or anti-US dollar philosophy. It's no entity outside of the jurisdiction or outside of the bilateral relationships between two countries should be able to influence that transaction. So part of the tokenization aspect and part of the stablecoin and the CBDC aspect is also part of the de-dollarization story that's happening around the world, which is happening regardless of the technology.
All right.
I think the multi-platform approach is super important, but then it implies directly another risk, right?
Yeah.
You need to be interoperable.
Yeah.
And what we have seen in bridges between blockchains and other pieces, these interoperability questions are easily the area of weaker spot. And then you have to be massively careful how you design it and how you implement it in order to make it still as good or as secure as a common platform as such, right? Because I 100% agree with you. The more diversity we have, typically the higher the innovation speed it is, right?
Thank you. Thank you so much for that. So as we look towards the future of money, tokenization is unlocking new possibilities, such as putting real-world assets like art, real estate, treasury bills, and stocks on-chain. So Simit, how can tokenization enhance liquidity and accessibility for traditional illiquid assets, such as real estate?
So I think when we talk about real-world assets and when we talk about liquidity, there's some asset classes that are very difficult to provide liquidity on, right? And part of the problem is the high cost of the asset itself. And so tokenization is one part of it. You know, you tokenize an asset class like, I don't know, cobalt or diamonds, right? The other part is fractionalization. So rather than having to be able to provide capital in the millions of dollars, you know, you can start capitalizing it with smaller amounts of capital across a multitude of people or investors. And so tokenization was one element, fractionalization is a second piece. As you fractionalize, you can introduce liquidity by also providing secondary markets so people can exit out of their positions in fractionalized asset classes. But you still need to, you know, have the regulation and you know, the AML, KYC kind of aspect nailed down, because you've got to have regulated secondary markets in which you can buy and sell some of this. But the other challenge is all about the delivery. So some of these assets need to be delivered, right, ultimately. And that's a problem that hasn't been fully solved. So I can buy an asset class and I can buy a fractionalized part of that asset, but what about if I want delivery of it? And then that's still a problem that exists and needs to exist. So yes, you can provide liquidity into illiquid asset classes, and you know, you can provide access to it to a lot more people, but the challenge is still how you're going to deliver on the asset when you need to sell. But that's something we can talk about later. We don't need to discuss that now. But when you take that concept and then you look at some extremely intensive capital assets, like, you know, we can even do cargo ships. Cargo ships, you know, you've got to invest hundreds of millions of dollars to buy or lease, and then you work on the yield over the next 10, 15 years. And so, you know, there's a project out there where you're tokenizing a whole cargo ship. You're having hundreds of thousands of investors investing into this cargo ship, and over the next 20 years, achieving a fraction of that yield to get an ROI. And so that similar concept you use in property, right? You use in land. You can use in, you know, other kind of business ideas like power plants. You know, anything that's capital intensive or where the liquidity doesn't exist in order to achieve it, and tokenization and fractionalization does help. Yeah.
Thank you. So,
Yeah, I mean, traditionally what you would have done is you take your power plant or you take your real estate, you put it in a company and you issue shares. Yeah. And that was the way it was always done. And now, obviously, the idea is, you know, instead of shares, we have tokenization. I think BlackRock has indicated they want to tokenize 10 trillion worth of assets, and they're working, I think, with Securitized to do that. I mean, there's definitely an appetite to actually start doing this, and we'll probably see it happen over the next few years. I think treasuries is something that's a bit of a success story. They're being tokenized at the moment, but as things move along, things will get more and more sophisticated.
Yeah, and I think part of the challenge is also, people use the word tokenization and have jumped the step of securitization, right? Because the fractionalization and the creation of the ownership share is securitization, which was a fantastic invention decades ago, and and tokens are an extension of securitization. And I think it's taken regulators, and there's been some very good advancements by many jurisdictions, including Switzerland, to acknowledge the fact that they can use tokenization to do already what they're doing with securities trading, and do it in a different way. Use a public ledger. Use private ledgers and public ledgers to keep records of that ownership, and not require, say, the operation of that ledger to require a full license as a CSD, as a central securities depository, which is very difficult to obtain. And there's been a lot of innovation in that, and I think that's a fantastic use of the technology, and many regulators recognizing the advantages of the technology.
Yeah, when we looked at that one and did some pilots ourselves, a lot of analysis behind that. If you take a value chain from issuing to really corporate action and closing, and would tokenize and fractionalize everything like that, you have the possibility of a cost reduction of between 40 and 60%, which is massive.
Yeah.
However, first, you need to have the platform, and only if you have are in a steady state, then typically the business case works. Second, you need ideally the same companies or people or market players who are repetitively issuing new tokens on it, so new securities or others. And third, at the beginning at least, this business case is totally killed by the new term sheet that you have to build, because the legal terms are different from before, and they first need to be developed in order with the clients, but also with the lawyers, and that unfortunately takes away all the benefits at the beginning at least. So, meaning you need to set it up once, you need to ideally create a standard for term sheets, and then repetitively issue similar bonds or similar securities on it in a similar way, and then you actually get to these benefits I mentioned.
All right, thank you so much for that.
I think it was just one more point on that. This trend of tokenization and fractionalization only comes up when credit markets are being tightened. When there's capital and there's money flowing about, no one talks about tokenization and fractionalization. As soon as that credit market, the tap is turned off, then people are starting to look for, oh, well, everyday investors should be investing in cargo ships and power plants. So we also got to recognize that this is influenced by trends. But the technology is sound, but we also got to be mindful that, these are trends and flash in the pan that will soon die out, especially when the credit market becomes buoyant again.
Yeah. I'd just like to add, and coming back to the money topic of this, I think all these tokenization platforms, in my years of experience, everyone had a great idea of coming up with tokenizing a real world asset, but then the question I always asked was, well, what are you going to settle it with, right? Because the advantages of a tokenization platform require some form of tokenized payment on the platform itself. And if you don't have that, then you still get some benefits, many benefits, but not all of them. And many of the exchanges and many of the many of the regulated exchanges for real world assets require the use of stablecoins, or require the use of a CBDC or an exchange-issued token, and often not just limited to sort of tokens that require pre-funding, because the market model is also incredibly dependent upon what that token is. And the way the markets work today is you are selling something you don't own and using money that you're borrowing, and everything is up in the air constantly during that T+2 period. So changing that and saying everything will settle instantly on a gross basis dramatically changes the way markets work. And there's advantages to that, but also significant disadvantages to that. And I think we need to be mindful from a technology standpoint that we need to support the market models. And we need to listen to the market in terms of what the market wants, to not just assume everything should settle instantly and atomically and payment is instantly made, because that's not often how the market works.
Yeah, thank you so much.
Definitely that. However, on top, you also have, the normal risk framework typically for securities from issuance, trading, and post-trade, and so on. But if you put this whole thing on a blockchain, you encounter a lot of other risks that are coming with that. The real-time settlement potentially is one of it. The other pieces around the technology as such are additional risks that you have to cater for, and typically traditional companies so far have only partially identified them and create new regulation or new controls against that in order to actually populate it. So what we currently are doing, and next week is consensus, so we will announce it there, is a risk and control framework exactly for these situations where you have a lot of other risks, we identified 30, where you actually can put controls against these in order to make it really secure and reliable.
Thank you so much for that. So, in response to the growing popularity of digital currencies around the world and tokenized assets, central banks around the world are exploring the development of their own digital currency, known as CBDC, or Central Bank Digital Currency. So I'll be asking you all, what are the key drivers? Simit mentioned this earlier on. So what are the key drivers and motivations behind central bank exploring the issuance of CBDC, and how might they differ from country to country? So I can start with you, Simit, anyone.
Sure. So as I mentioned before, the driver for CBDC differs. In large parts of the world, we're still reliant on cash, notes and coins. Retail CBDC is the prevalent use case that's being considered, because you've got to continue to provide access to central bank money in some form, and in a digital form, retail CBDC is that primary use case that people are looking at. Is the same driver for retail CBDC as strong, or does it exist here in the UK or Europe or the US? Probably not. I mean, most of us here probably use Apple Pay, Visa, MasterCard. We don't even care where the money sits or who's owning it or whose liability is. We tap, we go, and then we carry on. But that's not the same elsewhere, and therefore we've got to consider that when we talk about CBDC, and it's a generic term that covers everything, as does digital currencies as well. And so, depending on what the drivers are, what the needs are, and whose problem you're trying to solve, there'll be a different technology, different approach, different use case you're looking at. Like here in the UK, even though that there is a program from Bank of England to consider looking at, and the word that's important there is consider, a retail CBDC, there's only one part of it. They're also looking at stablecoin frameworks, regulated private money. And to me, that's probably a more logical route to go down in the UK and some of the developed markets. Elsewhere, you go to places in Africa or Asia, or even parts of the Middle East where cash is still prevalent. Are you going to be deploying a stablecoin solution where you need banking access and identities in order to facilitate movement of money? Probably not, because those things don't always exist, either as infrastructure or access. And so again, those are the different things you've got to bear in mind when you're doing it. And so whether it's CBDC or stablecoin or regulated private money or tokenized deposits or cryptocurrency or even meme coins, those are different options you can choose depending on what it is you need to address.
Thank you. Kai? The key drivers?
Well, I'd say we have seen quite a bit of innovation in the past, right? There's still tons of questions out, especially when it comes to CBDC. I think on that element, we always have to think from what is the use case, where are actually the business benefits or the user benefits in one or the other form of transfer vehicle, and being it a CBDC, being it a tokenized deposit or a stablecoin. Before any of these are implemented at scale, I think a lot of testing has to be done from what could happen in what we mentioned, financial shocks, but also do we have a second layer in potentially if we need, right? In CBDC, as we said, 90% of the central banks are investigating, analyzing that space. Some have implemented it. Some others are in the process, like the ECB. But it will take still some time before a developed country in the, let's say, Europe or US world will issue a CBDC. There'll be a couple of years out still. And I think with some pilots, you can test and learn accordingly and also simulate potentially some critical situation that need to be under control before you can actually put it in production at scale.
All right, thank you. Blake, do you want
Yeah, well, the Bank of England has given a list of reasons of why they want this. They say they want to give the public different options other than the existing ones. They want faster domestic payments, faster international payments, the ability to do micropayments and streaming payments, financial inclusion. There's a number of people who don't have a bank account in the UK, believe it or not, and this might be an option for them. They have a phone. They could use their CBDC on their phone and not have to have the bank account. Obviously, there's risks to it as well. They obviously have identified risks in relation to having a CBDC, such as a cyber attack would be pretty bad if you were totally reliant on it. The sand dollar, for instance, I think it went down for 3 months because someone didn't renew a security certificate or something. You know, that would obviously be a problem. It also could involve disintermediation of the commercial banks. So if you can have your money on your phone without having a bank, obviously that has an impact on bank deposits. And also there's privacy concerns out there as well, which have come up. You know, whether there's a lot of stuff on social media just about, you know, whether the central banks are going to be monitoring payments. They've made it quite clear that they don't intend to do that, that the data will be held by payment interface providers, and they will not be seeing that. They're also talking about baking that into legislation, that they won't be looking at it. But I think you had an interesting point about, was it helicopter money?
Yes, indeed. So when it comes to what's called helicopter money, some benefits from the state to people in need, you can actually put exactly these restrictions in place. Like there's a support from the state to pay the electricity bill, right? And when you have exactly the wallet of the electricity providers, you can check, is the token really moving in this wallet, yes or no? And if it's not the wallet, you cannot transfer the token. So with that one, the purpose-bound subsidies are really being able to land where they should be, and fraud on these things can be prevented.
Yeah, I have some examples I can talk offline with many people if they want to talk about Sweden and project we just completed in Kazakhstan for a production pilot back in November. But I think the most important thing, just tying this all together, is that from a CBDC standpoint and even from a stablecoin and tokenized deposit standpoint, is that it's incredibly important to focus on things that make it different than the traditional payment systems. If you sit there and you design a tokenized payment system that looks and acts and it does exactly the same thing as Visa and MasterCard, and the consumer experience is exactly the same, you're going to lose. And you're going to convince yourself the business case won't work. You're going to convince yourself that it's not a worthwhile aspect. But if you look at what the technology allows in certain almost niche use cases and niche aspects that are incredibly important, that shouldn't be forgotten, and that really drive the difference between an account-based, centralized, traditional payment system versus tokens and what tokens can do, that's really where you have the benefits. And every country will find different benefits and different reasons in doing it. Some may not. And I think, you know, part of the other thing I want to highlight before we conclude is that I don't think tokenization presumes blockchain or DLT, which is a very controversial topic, because many definitions of CBDC say, well, it's issued onto a ledger. But that is dramatically not what the Bank of India has done in terms of their UPI, and they're calling that CBDC. So the technology is not really what drives the definition here. It's the concepts, and it's what you can do with the new form of money, the future of money, that really, I think, really enable us to move into new use cases and new functionalities and really make the business cases work.
Thank you. So we are wrapping up now. So Blake, I would like to ask, if you had to give one advice to policymakers and regulators in the room right now on how best to navigate the future of money, what would it be?
In terms of navigating the future of money, I would say, you know, maybe just keep politics out of it a bit. That would be very helpful. You know, money is meant to be neutral, you know, value-free, and everyone can trust it. If you politicize the monetary system, you're going to get in serious trouble. So that's what I would say. I'm sure some of the other panelists would have some opinions as well.
100% agree. However, it is the world's most powerful tool, and I think that's you can win wars and fight wars without firing a single bullet, just by controlling the monetary system and controlling the flow of money, controlling the flow of messages through things like SWIFT. And I think we are entering a world that is will be much more fragmented, but will have regional players sort of coalesce together and I think increase their economic output. And I think that's a benefit for the world, not a negative.
Yeah.
And then always think from the business side. Well, try to better understand what's the problem I'm trying to solve here. And as long as it is multi-platform in order to foster innovation, then with all the three, we're probably good.
Yeah, and just because you're cheaper and faster and use cool technology doesn't mean you're going to win out unless you're addressing a problem or introducing something that is going to make it easier for me to do something. Adoption is going to be low. And I always use PayPal as an example. It's the most expensive form of payment. But what they did is it made it very easy for users to complete purchases online. And it meant that they were increasing the conversion rate of everyone who used it. So the merchant didn't mind paying 4 times as much as the interchange on Visa and MasterCard. And so unless you're addressing a problem and addressing a challenge or addressing a need, doesn't matter what you're developing or delivering, you're not going to get that adoption. So that's the other element, is making sure that you've got a use case, you understand the drivers, you understand the requirements, and you understand where that value exists and to whom. You'll be in a much better position to decide what you go with.
Thank you so much. Thank you all for sharing your insights and your expertise on this. So our panelists will be at the VIP lounge if anyone have any question to ask. So thank you so much for joining us. Please give a round of applause to our panelists.